the more trust you have from your investors, the less money they're necessarily going to require to go in with you. So it's got to be a fair balance of, if I have somebody who's doing something at 6%. So it's a fixed return at 6%. And they've got a huge name and they've got a huge amount of trust. And that's the only reason that they're going to be able to do it. Because if I went in front of their investors, there's no way they're going to they're not going to invest with me for 6%. It's not going to happen. So the trust scale is really what drives it more. Most of it is certainly over 10.
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randall. Let's dive in.
Hey guys, welcome back. It is great to have you here today. I am talking with Tilden Moschetti of the Moschetti Syndication Law Group today. It's always good to have a refresher on what syndications are, what PPMs are, what you should look for as a limited partner in some of these deals, and as a sponsor, what you should be doing as well. I mean, Tilden's an expert in the field, and so it's great to have him on the show and have him share his knowledge with us. We're going to talk about syndication again. So if you're looking for that, this is the show for you. We'll talk about some of the deals that he's working on. And obviously he is got an inside track on what's happening in the market because he sees a lot of people putting these deals together, different types of syndications. So he's seeing return profiles. He's seeing terms that need to be put in to the PPM and to the other regulatory docs. So a wealth of knowledge. And we cover a lot of that in this conversation. So if you're getting something out of the show, please go on, rate and review. It helps us a ton, as always. And we are still raising capital into the RAM Capital Fund, where we are going out and buying single family properties, creating notes. And so it's a Reg CF, it's a crowdfund deal that we have done. So if you're interested in that, please go to the show notes below and you can hear about that. All right. Without further ado, let's jump into the show. Here's Tilden. Well, hey, Tilden, I appreciate you jumping on. Welcome to the show. And I'm excited to talk to you today about syndications and just have you share your knowledge so that when we're going out, we're looking at some of these deals and offerings that are coming up, or we're trying to set our own up. We have a little bit better understanding of what's going on. So welcome to the show.
Totally. Thanks for having me.
Right on. So let's jump in, just briefly cover for those of us that don't know you. Tell us how you got into the syndication game specifically. And was that like what you had always wanted to focus on, or you found it through some other means of either investing yourself or something?
Yeah. Real estate is really what I was focused in on more than anything else. My idea was I was going to be a developer and I was going to build assisted living facilities with using manufactured housing.
Okay.
Didn't have any idea how I was going to pull that off, but I thought it was a great idea. So I looked around at a bunch of other developers. They were all lawyers in my area. And so I thought, okay, well, I'll go to law school and then I'll be able to talk what needs to happen. So I did that. Ended up, just because of circumstances, I ended up practicing law as a litigator, but just really in real estate around any kind of dispute that relates to like the valuation of real estate. So I didn't do landlord-tenant issues, but I always did things like property value, partner disputes, divorces, whatever it was, as long as real estate was a big part of it.
Yeah.
I hated it. Litigation is absolutely terrible for everybody involved. So I wasn't happy. And I was looking around and brokers seemed to be making good money. So I added some brokerage into my background, did a few deals, earned a CCIM. And then one of my partners on the brokerage side showed me a deal and said, hey, look at this. It's really fantastic. So I looked at the deal and was like, yeah, this is really good. And he said, we should syndicate it. I didn't know what that meant, but I figured I could figure it out. And that was the first syndication about 10 years ago. And did another, and then realized, well, why am I doing this? Why am I litigating? It doesn't make any sense. I really enjoy putting these deals together. Why don't I just do my own deals and also put deals together for other people? So I started doing that and love it. So
nice. All right.
It's now a great job.
Yeah. No, I love that backstory. So then on that first deal, what was it? Was it because when you first started saying you started a brokerage, I didn't know if you were talking on residential or commercial?
So I was on the commercial side. So okay. It was a medical office in Decatur, Alabama, and it had just been developed. So I was buying it. The developer wasn't really. They just kind of wanted to be done with it and go on to the next project. They weren't looking to make maximized fees. And so we got a really good deal. And we're
Nice.
able to buy it, sold it after the rent bumps, and
Yeah, fantastic. Okay. So you both sides of the deal then. So you're on the
yeah,
ownership side and the syndicator side,
yeah,
and as well as the legal side. So it's funny because when I used to work for an attorney, it was this very similar approach to it. I was like, I'm going to go to law school and I'm going to, this is 2008 when I just came back from Australia.
Mhm.
And in the process of going through that, I was like, I'm going to go work for an attorney who does a lot of investor deals and see if I kind of want to do that. So I never went back to law school. I audited some classes and did that, but I got on the, investing side of the business and never went back to law school. But yeah, it's certainly beneficial and helpful because I saw him through his syndications of some of the deals that he was working on, some storage facilities back then. I mean, he was doing all his own PPMs and, managing that whole process. So it was interesting to see that side of the business as well. So
totally.
yeah. So, okay. So you were doing that. And then, so you've morphed into straight syndication side of the legal practice. Are you standing up the syndications or are you still having to do some litigation on the back end if something goes wrong, or you just,
I only do people. If it's a Reg D, I do it. So, but I don't do any litigating on if there was a dispute. I don't represent investors. My clients are putting the deals together. If anything were to happen, I'm not the attorney that's going to litigate it.
Yeah. Okay, good to know. So, all right, let's walk through syndications. I've covered it on the show. We've had other attorneys on, but I think it's always helpful to just go back and kind of discuss the basics of what it is. So again, if you're looking to raise capital from others and you're selling a security, this is what we're talking about right now. Okay. So just tell us, what's syndication? When would you use it? And just really high level so that we can start the conversation from there.
Sure. I mean, briefly, anytime you're raising money from a passive investor and the goal is for them to make money, then it's a security that has to be registered with the SEC, which nobody's going to do here because that means really like going public and it costs millions of dollars. That's not it. We're talking about an exemption to registration, which lets us basically raise an unlimited amount of money from an unlimited amount of accredited investors and sometimes raise money from non-accredited investors. The reason you do it is really because you want to go bigger and you want to do bigger and bigger deals. So you want to not only do the single family home or the small apartment building, but you want to do a really big apartment building or a really big office building or whatever it is. And so you need additional capital in order to do that. And at the same time, you'd like to make a little bit more money than by using other people's money, which is what the role of a sponsor really does. So really, it's always a balancing act between borrowing money through financing and also using syndication and using the investor money and really coming up with a nice balance that really maximizes. Ultimately, you want the best profit for you, but also you need to make sure you're getting a good return for your investors.
Hey everybody, Randall Cleared here with a special shout out to our friends over at Envone. If you're looking to diversify your investment portfolio, you've got to go check them out. It's envone.com. It's a crowdfunding platform with a wide range of investment opportunities, things like real estate investing and even bourbon barrel investing. So check them out. Envone hosts our crowdfund. It's actually a single-family real estate investment fund that we have launched with them, and we've had an awesome experience working with Levy and his team. They're super responsive, very quick to assist us with things that we need, and they have crowdfunding down to a science. Go ahead and check out episode 154, where Levy and I discuss crowdfunding in detail and how it can help you either invest or raise capital. And check this out. As a friend of the pod, launch your crowdfund with Envone, and you're going to get an exclusive 10% discount when you head over to envone.com/ABC, or simply call Levy and his team at 475-800-8716 and mention Agents Building Cash Flow. Go crush it. Happy investing. Talk to you later. Yeah. So when does it make sense? At what price point? Right? Because $500,000 house, you're probably not needing to syndicate. Yeah. So the cost
you technically do. So even if you're raising $1, you still need to go through the motions. So it probably doesn't make sense to do that deal if you need to raise, that dollar, but it's still a security and still it's, a securities violation if you're not properly underneath an exemption like Reg D. that break even point, I typically tell my investor or my sponsors probably about 1 million. That's where it starts making sense. The returns your investors are going to get based on taking into account attorney's fees is where they start. It just starts to make good returns, good enough that they'd want to invest in it.
Yep.
Below that, it's going to be eating into a fair amount of the return that they're going to get.
Yeah, to that point, it's more along the lines of if you're going to do some sort of JV or you're just going to borrow and they're going to be a lender on a deal, right? Instead of like private money on a deal. Yeah. So for a lower dollar amount, would you recommend that? I'm not an attorney. I'll let you say what the recommendation would be if it's below $1 million.
Yeah, I mean, probably I'd be looking at, if it was lower than that, I'd really have to kind of see if I'm going to be able to get a great return to offset that price of the basically paying for legal fees, then maybe I'd still do it. Yeah. The smallest deal I think I've put together was 200,000 for somebody. They wanted just the experience of going through the process and then ultimately to do more and more bigger deals.
Got it.
And so that was okay. But more, it's really got to be, there's got to be an overwhelming need at that lower price point to do it through syndication rather than using hard money or something like that.
Yeah. Yeah, for sure. Okay. Just again, want to cover that. It's not a, what is that saying? It's like not every nail needs a hammer or something. I don't know what that. Yeah, it's not for everything, but yeah, you can edit that out.
It can be for a lot of things, but yeah, it's a tool in your tool chest. So it's a way to get deals funded. Sometimes it works great.
Yeah. Okay. All right. So what are you seeing right now in the market? Again, we've covered syndications, and I can point to some of the other shows if you want more detail specifically to syndication, setting them, that sort of thing. But what are some of the deals that you're seeing right now? Because how many of these, I guess let's just cover how many syndications are you standing up at any given time? Like, what does the operation look like that you guys are running right now?
Yeah, I do about 100 a year for clients. Right now, we're looking at just putting about 2 or 3 together, probably within the next 6 months for myself, and then maybe another 4 or 5, 6 months after that.
Okay. So what are some of the deals that you are seeing right now? The deal flow has changed a little bit on like multifamily front. It's died off a little bit. So what are you seeing people setting up syndications for predominantly right now?
Yeah, about 2 years, 3 years ago, it would have been mostly development or buying value add multifamily. I don't see a lot of it at all right now. I've still got a lot of development of single family, development of land, getting entitlements through. I got a ton of people who are doing hard money lending and looking for capital to basically lend out. And then there's just a lot of people like kind of like coming up with more creative ideas. So not that apartment building, but maybe it's, okay, we're going to convert that apartment building into a hotel or something like that.
Yeah. Or hotel conversion, condo conversion sort of stuff as well. Interesting. Yeah, I'm always curious. And again, you get to see and set up a lot of the terms in these syndications. And so there are infinite number of ways, obviously, to set these things up and depending on the return profile that you're looking for and that sort of thing. But do you see a common theme right now in this market with capital raisers and what they're putting together as far as return profile or?
I mean, it's got to have a one in front on what the return your investors are going to get. I mean, it's always a balance between how much, the more trust you have from your investors, the less money they're necessarily going to require to go in with you. So it's got to be a fair balance of, I have somebody who's doing something at 6%. So it's a fixed return at 6%. And they've got a huge name and they've got a huge amount of trust. And that's the only reason that they're going to be able to do it. Because if I went in front of their investors, they're not going to invest with me for 6%. It's not going to happen. So the trust scale is really what drives it more. Most of it is certainly over 10. And it really depends on, safety. Is it a cash flow play? Is it appreciation? What's that whole deal structure look like? And then we work backwards to there and figure out what the splits need to look like and in order to put the deal together.
Yeah. Are you seeing more and more like debt funds or income funds?
Yeah.
Straight yield plays.
More.
Yeah.
Yep. Yeah. Well, and that was really rare. I remember the first one I got and it was like, really? Well, that's a little strange, but sure, we can write it. We can do it. And now it's like, I don't know. Maybe it's like 30% of my business, 40% of my clients. It's a lot.
So again, just going back, if I got somebody, they're looking to set one of these up. What is a typical cost that we're looking for a, boilerplate 506C $20 million raise? Like what is
Yeah, I
something like
don't,
that?
I do flat fee. I don't charge based on anything else. It's probably going to be somewhere across the board between attorneys. It's probably between, I don't know, on the lower side there, they don't really do a lot of these deals. It's probably going to be about 10,000. On the upper side, maybe 25,000. If you're going to a big firm, it's going to be 40, 50,000. So.
Yeah. 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 Okay. Again, just that's a conversation we were talking about a minute ago where if you're doing less than $1 million deal, the legal fees actually do come into play. You got to take that into account whenever you're looking to set these things up. So I want to go through and kind of address some of the items that an LP should look out for in like a PPM or in the setup documents. And then the other side of that, what the sponsor should be putting in the documents that sometimes you see is left out. Sure. And then we can just go from there.
Yeah, I mean, I think the first thing for an LP when they're looking at something is, does this look like a pro? Like, is this a pro doing this or not? If the documents basically look like they could have been written in crayon, then run for the hills. It's not worth doing. They don't know what they're doing. Don't do the deal. So I tell my clients, you need to show up like a professional, and LPs should demand that. So that's one thing. The deal's got to look, make sense to them as well. It's got to be something that they can see how, the projected returns are going to be reached. If I could put a PPM out there that says, we're going to double your money in 2 weeks, but, any investor should see that and be very suspicious of it unless I've got some really great plan that I've outlined for them. They need to understand how I'm going to get there if they're going to put their money on it. So certainly those things. In terms of general terms, I'd look for things like, am I going to get diluted out? Are they going to be buying this property and then buying another property and not taking into account any appreciation in the first property when they're selling it out to the second people? So those kind of open-ended funds or blind pool funds that are going to be over a long period of time are going to dilute out the early investors if they don't have mechanisms in place.
I was going to say, what kind of mechanisms can be put in place that would allow for that not to be diluted?
Normally, you'll have a periodic basis of, okay, we're going to raise on these kinds of schedules. We're going to determine the net asset value, and then we're going to adjust the unit price on each offering to account for that. It's exactly the same way a private REIT works or even a mutual fund works. So You're just adjusting to the market price. So then the price they're paying in at balances out with where you're at.
I've seen that on some evergreen funds. And when they have that, and I've seen it where it's not in there.
Yep.
And so how often are you recommending that they update?
As much as they can and not go absolutely nuts doing it. If you were doing it quarterly and you're a small shop, you're never going to get it done. That's too often. But if you're I have a huge developer who does a lot of product and they make a lot of money. They do it quarterly, but then they adjust it at the end of the year. But they've also got 20 accountants, right? So it's not a real big deal for them to come up with the net asset values for these things. For most shops, if you're doing it once a year, that's great. Really, it's whenever you plan on sweeping in new money, I would do it.
Yeah. Got it. So that's some of the things that you're looking for as a limited partner. And again, on the other side of that, if I'm a sponsor and putting something together, say it's a multifamily deal, $15 million purchase, and we need to raise, $7 million. What should I be putting in my agreement that you may see left out sometimes?
You may want to consider, you don't always have to put it in, but you may want to consider putting in a capital call provision. What happens when that multifamily building is underwater and you've got no more reserve left? It's useful to have what that capital call structure is going to look like. I don't say it's required necessarily because everybody's going to be incented in order to make the deal work. And if it's that bad, you're going to go to all of your investors. You're going to tell them what the situation is. You're going to suggest a solution to it, and you're going to have to see if everybody goes along with it. It's not the best way to do it because everything's kind of up in the air. It's much better to have it kind of laid out, but sometimes we don't lay it out. So that's one thing to definitely consider about. Also, just making sure the risk profile is right. is important. Making sure that the risks that are likely to happen with any property is there. We certainly were talking about COVID a lot for multifamily buildings, rent freezes and things like that. Now we're probably talking a lot more about interest rate changes still. I still generally will write something about what happens when rates continue to go up. I talk about changes in unemployment that may have a dramatic effect on a specific multifamily property. Things like that need to be taken into account.
Yeah.
And then, yeah, things like that.
Okay. Yeah, just curious. Again, you've been doing it for a while, so obviously things have changed, and you keep adding, I guess, to the PPM, and that's how that document is getting bigger.
It's always evolving. There are things I'm always putting in or taking out, and it's kind of whatever's going on at the time.
Yeah. So you mentioned that you are setting up a few for yourself. So what are you currently targeting? What are you looking at and investing in? Is it real estate based or something else?
All real estate still. So I'm putting together a logistics deal in South Texas. I'm putting together a triple net fund. Those are the two deals in the next 3 months, 4 months. So.
Okay. Can we talk about them?
I may not answer all of it.
All right. I'm just kind of curious to the thesis in general. If you haven't stood it up and that sort of thing, so the logistics, is that a single asset syndication, or is that a fund that you're setting up, or what are you doing?
The logistics deal won't be a fund. It will be a multi-asset, but it's all in the same region. It probably have a similar, it's all going to be in warehousing and trucking and things like that.
Got it. Okay. Like iOS or more a mix of iOS and traditional industrial?
All just pure logistics. So it'll probably be that either, I forgot what they call it. Certainly that warehouse space, or at that point where they drive it over the border and need to get it certified into the U.S.
Got it. Okay. Interesting. And then on the other side, you said you had another one. What was the other one?
And I'm putting together a triple net fund. And there it's not my normal, but I love retail. Retail's kind of like my favorite product type. I don't do a ton of it, but I like it. And so it's just going to be snowballing cash flows. So, all right, cash flow building, buying more assets, buying more assets, buying more assets.
Okay. So just walk me through it. I like learning why retail right now, and what's the experience you've got in the retail space. Why is it your favorite?
Sure. I like it because it's more complicated. The lease structure is much more interesting. Working with tenants and trying to figure out what the optimal lease terms for them are, but still the optimal for you to kind of balance it out. Coming up with rent increases. It's just all fun and interesting.
All right. Nice.
And then putting it together. It'll probably morph itself into more of a private REIT, just because of generally how the structure will go. It really will be not super cash paying, which is a little different than most REITs, but snowballing reinvestment of revenue into acquiring more. And why? Because retail's hot right now.
I've seen some of the price points on it, and it seems like it's in a decent spot to acquire.
Yeah.
I was just curious about the actual lease up and if it's still hot. So it sounds like you are hot on it. Are you focused in a certain region or part of the country?
Probably not on the West Coast, probably mostly mid-America to the East Coast.
Okay. And any idea on the return profile? Can you talk about that or not?
No, still haven't underwritten it yet. I've got an agent that I've worked with for many, 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 many years, and he sent me a bunch of stuff to start underwriting. So I haven't done that yet. I intuitively think it's going to work, but we'll see. Maybe it don't. Yeah.
So again, are you structuring that as a completely separate business model, obviously from the legal practice? And so what does that look like? Are you providing legal, or are you the sponsor? You're running the entire thing. So you're going your acquisitions and everything.
We'll be the full sponsor. And I have a reasonably sized small team that can manage whatever we need.
Nice. Okay. Yeah. I just didn't know if you were having outside partners that were doing all of that. You're working on that legal side and structuring the financing and that's what, or the.
Yeah. I'll do the legal because, hey, I'm free. But
yeah, exactly. Yeah. So my old boss, that's why he's like, it's great. Get to do all my own stuff.
Exactly.
Okay. Well, again, I kind of went on a sidetrack there, just talking about real estate in general, just because I like to know, what you're working on, what you're seeing. Sure. So again, have you seen terms change on offerings in the last 3 years compared to prior to that? And if so, what are they looking like now? I know you said neither one in it.
We're seeing a lot more fixed rate terms than before. we're seeing a lot less of the fancy waterfalls, which thank God for, with, well, when it hits this IRR, it's going to be this split and this IRR with this one. I had one that was 7 layers deep, and that was ridiculous. So we're flattening that out, which is good, because investors, it's just confusing for investors.
Yeah.
It doesn't make any sense. The durations are probably slightly shorter. I don't really think I even have in my stable right now any 7 years. I think everything is 5 or less. So durations have gotten shorter.
That's kind of interesting. I would think it would be the opposite, but
yeah, I guess it's, I don't know. I guess the projects just in general, they tend to be, people are a little bit more worried about getting their cash out. And so
that makes sense.
What do they need to do? So.
Yeah, that makes sense. Well, okay. So again, you're on both sides of it. You see the legal side, you're doing this for other people and for your own opportunities. So do you have any tips, strategies for effective capital raising? And how has that evolved?
So, I mean, my whole thing is that this comes from my first deal, and my first pitch to an investor is what I call like founder investment theory. So the founder investment theory is you've got to have the story to the property. When you're putting an investment together, it's not enough to just say, well, we're getting a 18% IRR, but and a pref of 8%, because it's just not, that's not getting people. Because when they see that 19% on that next page, they're going to go to that. So that's not how people make decisions. People make decisions on emotions first, and then they make a rational decision to support their emotional decision. So the numbers still have to make sense, or they won't be able to convince. The rational part will be like, we got to go out of this. It doesn't make any sense. But they're really making it on emotions first. So the story has to be good. And so that story needs to be like, why are you doing this product in the first place? Why this, if it's a specific property, why this property? I mean, is it, and it needs to be better than, it's got a 17% IRR, whatever the number is going to be. It's got to be, well, here's what's going on in the market, and here's why my team is especially suited to understand it. And this is what else is coming to the table. And, we also think that in this region, we've got this company coming in that's going to really drive up rents and raise the whole standard of living. So it's really an appreciation play as well. All that's got to be there in order to be able to talk to an investor and get them from, I don't know anything about your project, to, wow, here's $100,000.
Yeah.
So that's kind of like the biggest tip I've got for people.
Yeah. Fantastic. So how does the conversation change if you're doing a C, right? You're marketing to people that you've never met before. So how does that conversation change from investors who have invested with you in the past compared to those you have never met, and maybe they're responding to some ad you put up?
It's not too different. So I hardly ever talk about numbers at all. I mean, it's in a pitch deck. It's there, but I don't talk about it. It's not how they're going to be deciding. And they probably are going to ask questions about those numbers. And that's good. That means I've made it past the emotional side enough that the rational side is now wondering if this is a good enough deal for them to invest into. But so that's a good indicator. But most of it is talking just about the story and why this is a great property, or why this is a great region, or why my team is the best, or whatever it is. And then, it gets shorter for my past investors. Probably about 70% of past investors come on the next deal with me right now.
Yeah.
So them, it's shorter. I don't have to pitch them on the team. They know that part of it, but they still want to know the vision, because I don't do the same thing over and over. I don't always there's a lot of multifamily guys or storage guys or whatever, and that's great for them. It's just not what I'm into. I like interesting deals that are fun to talk about. And
I love hearing that. Yeah. I was talking to a guy the other day, and we were talking about just, are you working on anything interesting, right? Instead of just like, there's another 80 unit, 150 unit, whatever it is, same thing, cookie cutter style. And that's all well and good, pays the bills, that sort of thing. But sure. Is there anything else interesting that you're working on?
There's definitely nothing wrong with it. It's just different. I wouldn't be a very good salesperson for it, because I don't find it interesting. And if I don't find it very interesting, I probably can't sell it very well.
Well, let me ask you this then. So you have to get people into your funnel. And if they're not, let's say, referrals from current investors, then what are you putting, or what kind of advice do you have for sparking that emotional response in an advert you may be putting out to get those people to call you on the idea or the story of a
The
property?
best I can give you is an example of what not to do.
All right.
So, and there I have a client who was having trouble with marketing. So we got on the phone and I said, show me the ad first. Show me the ad. So he shows me the ad. He paid a marketing firm a lot of money to put it together. And, they're selling the pay-per-click ads and stuff. And some of these guys are great. This particular company was not. It was an AI generated video. You could tell the voice was AI. It only talked about 16% IRR. I mean, it was the worst ad in the world. I mean, no wonder he
robot
didn't have
spewing facts about something.
He didn't have a single click because it was so terrible. I mean, I probably would click on it personally just because I would want to know who the heck is doing this deal. But yeah, he'll never get a deal. So, I mean, it's got to be a hook that's interesting. Get on video yourself and pitch it, because people only invest with people they trust. And if it's a mindless voice or even just plain text, they're not interested.
Yeah. Okay, that's really good advice. Again, it's the facts tell, story sell. And yeah, if you're putting yourself out there, then that makes sense that you'd be getting the emotional response early on. I guess, again, it's just one of those things. You're not going to get on, or your advice, it sounds like you're not going to get on and just say, hey guys, 123 Main Street, 17% IRR. Check it out here for more info, right? It's got to be some kind of creative.
Yeah, I probably talk about, whatever makes it kind of special. There's a lot of these properties, even the ones that you think are kind of cookie cutter, sometimes have something really cool going on. And so it's like, oh, okay.
Pitch that.
Yeah.
Okay, sounds good. All right, so that's on the capital raising side and some of the tips that you have there. But how about on investor relations? And once you have a deal and you've got a syndication stood up and you've deployed the capital, you have the asset, what do you recommend, or what tips do you have around investor relations in general?
Communication is number one. So I occasionally get calls from investors wanting to sue their person. And the one thing that is always true, besides losing money, is that they never heard from them. So you got to get on the phone. You got to send emails just all the time. So your updates should come out quarterly at least. Monthly is a lot, so you probably don't need to send it monthly, but quarterly, absolutely. And it's got to be good. So it's got to be, I would take pictures of the property. I would give metrics about how things are performing, what I'm seeing in the market coming up, write a full on narrative. My emails generally are pretty long when I write to investors. The narrative is probably 500 words, 700 words. It's a lot. They may never read it, right? And I recognize, because it's kind of boring, that maybe they're never going to read it. But they know that I care a lot about the property, and so therefore I care about their money.
Yeah.
The fact that I always put, like, if you have any question, give me a call anytime. We'll talk right away. I mean, it's critical. They know they can call me about anything. If they want to know why I decided something, they can call. If they want to know what's coming up, they can call. They just want to catch up, they can call. So that's what makes alternative investments so cool. All right. If you invest in Apple, you cannot call Tim Cook up on the phone and ask him, how he feels about the Google lawsuit. It's never going to happen. You're not going to get him on the phone. Maybe one or two of your listeners can, but I can't.
Buffett might. Yeah.
So I can't call him on the
phone.
Phone. But they can call you. And that's what makes it so kind of awesome and democratized finance. I mean, that's what makes our whole thing that we're doing so good. So communication is like that's the beginning, middle, and end.
Yeah. It's interesting you say that, because one of the very first conversations I had when I was going out talking to some investors that I'd never met before, they're like, why should we invest with you compared to this other thing, or putting our money in the stock market or whatever? And that was the exact response. It's like, I'm here sitting in front of you at your dinner table. You get to talk to me whenever you want to talk to me. So yeah, it's an interesting dynamic to be able to say that.
Yeah. The guy who I did my first deal with, he went in on a syndication deal long before we did our first deal together. And he showed it to me. He hadn't heard from the company in 3 years. He only got a K1, like not even an update. I mean, oh my God. I mean, even if your returns are great, you're going to hate them, right? Because you have no idea what the money's doing.
Yeah.
So
Yeah. What happened after that conversation?
Well,
I'm reaching out tomorrow.
He couldn't really get it out. He really couldn't get the money out. So
Oh,
I
really?
think they finally did sell it. And I think they sold it at a good profit. So, but man, they just lost being able to get another investor, getting them to reinvest. So,
yeah. Well, let's talk like best and worst. Again, you get to see a lot. And that's what I really enjoyed about working with that attorney when I was doing the same thing. I got to see a lot of investor transactions. I was doing a lot of the title work and that sort of thing. And so I had stories just from that. So like, what's the worst thing you've seen a sponsor do?
The worst deal I've seen didn't become a client. We didn't accept them as a client. And I'll obscure the facts enough, but they told me that they were going to buy a very prominent national park in the United States, and we're going to build condos on it. I'm just like,
okay,
no, you're not.
You're going to be in the Bahamas.
You're never going to buy it. It's a national park. Yeah. You realize that, right? So yeah, that was pretty crazy.
All right.
So that was the worst. Best, there's a lot of best, just because, any great idea, I don't get it. A lot of the things I hear over and over again, and I'm always happy to work with on those. But every now and then somebody will come up with something that's totally novel, and
yeah, I guess that's it.
And that's all very exciting.
Yeah,
but those I can't share.
Oh yeah. It's one of those. What's the most interesting thing that you've seen somebody raise capital for? I guess if you can answer that, it's like, is it always real estate? Are you focusing mainly on the real estate?
Oh no, I always try and keep my eyes open on everything. Most of it is real estate that I see, but there's a lot of cool companies that are raising funds that are, not really startups, but just kind of looking for additional capital. That's fun to see. I guess there's one I can talk about because I have a YouTube video about it. I think the best idea I have seen in 10 years is, this isn't my company. I have no affiliation with them whatsoever, and I don't know any of the specifics about what they're doing. So there's the preamble. But there's a company called Masterworks that they're doing a lot of advertising too. And so their thing is invest like the billionaires invest, and they invest into artwork. And so they have a whole model of how they buy artwork and then resell it. They basically flip it over a period of 3 or 5 years by identifying undervalued artwork that's really like Banksy and like huge names. Very prominent artists. They're so slick. Those guys are really good. Great idea. I envy them because I wanted to come up.
I've seen it, and it is cool the way they've set it up, because you're buying not necessarily a fractional interest in that, but is it a fund or are you buying fractional interest?
No, you're buying the painting. You get to choose on each painting that you invest into, which is so cool. Yeah, I'm totally jealous. I hope they make billions because it's so good.
Yeah, for sure. Awesome. Well, I appreciate you jumping on, sharing your knowledge, information. I'm going to link to your contact info in the show notes. So if you're looking to set up a syndication in real estate or for some other reason, then by all means, reach out to Tilden and his team and talk to them directly. I know you have some opportunities coming up as well. So I don't know if you're raising from outside people or just within your network, but if
first it's going to be in my inner network, but it's possible. There'll probably be links on my website ultimately to an offering if it's more public. So
okay, sounds good. Well, either way, again, I appreciate you jumping on. It's always good chatting with the legal side of what we do and figuring out, one, if we're in compliance and what we're doing right and wrong and all that good stuff. So I really appreciate your info, and we'll catch you guys on the next episode. All right.
Absolutely. Thanks so much.
Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.